We can certainly see, Jeff, real sensitivity in the equity markets here. Is this the equity market waking up to the reality of anything concrete coming through by March 1st?
Let's just call it a dose of reality and adjustment in expectations. Having said that, it's clear, from the rhetoric on both sides, still really do, want a deal, and also there's enough flexibility, written around the March 1st deadline, actually, to sort of kick the can down the road a bit as well. So, this isn't exactly, just everything falling off the table. But at the same time, I think it's a healthy dose of reality. Is
that all the markets need to see, just that those extra tariffs are not imposed, or the can is kicked down the road? I think a combination of both. Ideally, agree to a more permanent ceasefire, or if that's the best way of calling that. But at the very least, no escalation. I think that will do for now. So, and I think both sides are still on track for that. Yeah, Simon, equities selling off. We're seeing yields move lower. There are other reasons for that, which we'll come on to later as well. However, dollar-yen really steady. What's going on there?
Well, I think it's there's the potential swamp of liquidity into the foreign exchange markets. I think it's not just dollar-yen. You can see it in euro-dollar, which hasn't moved in 4 months. And I think it's that almost a race to the bottom now that people are expecting with regard to monetary policy should the situation in global markets get worse. I think it's an important point. Should. I think what we're seeing right now with equity markets is interesting if you take back and you consider it in the broader context, because what you've seen over the last 4 or 5 months, in terms of the rhythms and the depths of the moves in the big global indices, particularly US indices, very, very, very similar to what you saw in late 2007, very, very similar to what you saw in 2000. So it's a question of whether the market's natural pessimism, if you like, as we've taken away monetary policy stimulus, can be dealt with now by what the central banks do, whether they can come along and give enough to ease the situation. And I think, actually, that's going to be critical to what happens to dollar yen and everything else. OK, and what about dollar yuan then? That's not moving a huge amount today either, but you've kind of highlighted in some of your research that you've seen more overnight volatility in the yuan than in dollar yen. Well, there's certainly been a couple of days when that's happened. And I think the big irony is, of course, that over the course of the last few years, fingers have been pointed fairly steadily at China with regard to currency manipulation. And yet, if you look since 2014, you've seen a steady increase in volatility on a day-for-day and longer basis for dollar yuan. And this comes exactly to the point that actually volatility in other currency pairs has been coming down. And again, I'd argue a lot of that has been down to easy monetary policy settings in places like the US and Japan. So the irony is we're going to get to a point probably 6-12 months down the line where you could regularly be seeing just as much volatility taking place in the yuan. And the irony being, still China's the one being called the currency manipulator. Yeah. Jeff, is this a market that's more skewed to seize on any bad news or good news?
That's a tricky question here, because at the same time, especially with respect to, I would say, China-exposed currencies, that's been in the sense that bad news is good news, right? Because the worse, Chinese data gets, then the more likely, or at least the impression is more likely, you might get a big bang stimulus from China, and then you don't want to stand in front of an Aussie train or an iron ore train or something along those lines. And I think it reflects positioning as well. Markets having relatively underpositioned in emerging market currencies in particular. So, that might just, wear off the effect of bad news at the same time. Yeah. Speaking of good, bad news, risk on, risk off, Simon, I've got a chart showing the Aussie Swissy snapping a rally and turning lower that could hint at risk off sentiment. Is this the return of the pain trade? I think potentially it is. Again, it depends on what happens right now. This point, typically, in the cycle, this is where the biggest amount of risk will come for equity markets. If the central banks can handle it, great. But where we are right now, is there a risk to the downside on Aussie Swiss? Aussie yen, obviously, been the classic in these particular circumstances. Yes, particularly when you've seen relatively low volatility in that pair over the course of the last few weeks. So people aren't going to be ready for a big move if we do go risk off in a big way. Yeah, and cross-asset volatility has actually been low as well, Jeff. I know a lot of that has to do now with the sort of dovish tilt we've had from central banks. Is there scope for that to pick up a lot more as the year moves on? We still think it's going to be a volatile period, and you're taking a step back, shifting out the noise. Fundamentals are pointing to greater policy volatility. That's just a byproduct of, growth expectations being relatively soft as well. I think the Fed's dovishness, was a bit overpriced heading towards the end of last year,
when we meet clients and the first question in any meeting is, do you see a recession? So no, that's the straight answer. But you can tell, that's where people want to put protection on. We will get periods during the next 12 to 18 months where those recessionary, I would say, alarm bells might come back. And that's where the potential is, for volatility to pick up again across asset classes.
OK, and if that volatility does pick up, you're ready with what currency pairs in terms of where to take opportunities, Simon? Well,
I think I'd have argued traditionally it would have been dollar-yen, but clearly over the course of the last 5 months that's proven not to be the case. Look, if we're going to get some kind of move to the downside in terms of risk off, were we to go for that particular story, then clearly you're going to be focused on those China trades. And I do think that you see in the race to the bottom, potentially, in terms of monetary policy in places like Australia and New Zealand. I think anything that's around the Aussie and the Kiwi right now, that's where you're going to see volatility most directly connected to that, and equally to the upside as well. Should things start to improve and the China trade improves, so actually, as Jeff said, you're going to get that big move to the upside. So that's where I think the interest is.